Okay, so let's kick on today. Welcome back to today's class. I will share my screen again so that we can all kick off. So today we want to continue with IAS 12 that we started. No, yeah, IAS 12 is income taxes that we started the other day. And we've been able to look at a lot of things in that standard, and we want to solidify our knowledge of that standard today. Then from there we can move along. So this is not new to us. We've done all these before. We've done IAS 36. So we are going straight down to income taxes. So let me quickly go straight to the bottom. So income taxes is starting from here. Yeah. So we've looked at, we said that there are two types of accounting profit. We have the normal, there are two types of profit, I mean to say. We have the accounting profit. We also have the taxable profit. And I also told you that to get the taxable profit, you always start from the accounting profit, where you take the accounting profit, you add back all the disallowable expenses. Those are the expenses that is not allowable. So you add all of them back. And when you add back all the disallowable expenses, you now less the allowable expenses. So most times, the expenses that is allowable that you've not taken into consideration will always be your capital allowance. So you less these allowable expenses, and after you've less the allowable expenses, what's left, you are going to have what we call your taxable profit. So it's on this taxable profit now that the taxman will now multiply by the tax rate. When they multiply by the tax rate, then they get the actual tax that you ought to have paid. Moreover, you would have done your calculation based on your accounting profit. Okay, you would have done your calculation based on the accounting profit. Then there could be a difference between what you got as tax that you are going to pay and what the taxman actually says you ought to pay. So that give rise to what we call what do we normally call the differences between those things? Temporary difference. So you give back to what we call temporary difference. We also went further to say that when you take the tax rate and you multiply it by the taxable profit, what you're going to get is what we call the current tax. There's what we call the current tax. Then after we are done with the current tax, then we are now going straight to what we call deferred taxes. And before we go to deferred taxes, we also told us that there are certain things that the taxman doesn't allow. Example of such is when you are having accruals in your account, you are creating provisions for accruals. So the taxman doesn't allow it because the taxman calculates taxes on actual cash basis, whereas we, the accountant, we normally calculate our tax on accrual basis. But the taxman, even in government, they do cash basis. So they only incur expenses when they only spend whenever, they only recognize expenses only when cash is involved. That means that if cash is not involved, they don't recognize an expense. Are we together? Let me get your feedback that we are together, they are following. Can you hear me?
Yes, we are. I am following.
That's good. Thank you very much, sir. So now moving on, I told us that anytime you have accruals will lead to what we call provisions. Okay, you are going to go and create provisions in your financial statement, and that is going to be disallowed because the taxman only deals with cash. They don't actually deal with anything that is not cash. Okay, so we'll now go further to also talk about other things that might also give an issue in tax computation. Okay, we've looked at a lot of things that's going to be disallowed based on what the taxman is going to do. We talked about depreciation. Depreciation is always not uniform. The depreciation method that a company A is going to adopt will be different from the depreciation method that company B will adopt. So there's what we call, there are different depreciation methods. The depreciation methods are not uniform, so therefore it doesn't give the same result. Therefore, they don't allow depreciation. They also say that is a non-cash item. Whenever you do depreciation, money does not move out. But you go to the financial statement and then you go and you go and charge an expense as if you have actually paid money to somebody. But when you do your computation of depreciation, in the actual sense, money is not moving out. It's not moving out at all. But you go to the financial statement and go and treat it as if you paid somebody money. So they say depreciation is not a cash item, and therefore, because depreciation is not a cash item, and because there are different methods of depreciation that gives different answer or different result, the taxman does not allow it. In place of this depreciation, the taxman calculates this capital allowance. So there's this uniform rate that is used to calculate capital allowance that across board, everybody is going to get the same result. Okay, so that's what they now give us in lieu of depreciation. Okay, now the next thing I also said is I said anything provisions is always going to be disallowed. Provision for bad debt is disallowed. I also mentioned the other day that even this interest expense payable. So this is anything accruals. Interest expense payable is allowed. Provision for bad debt is actually also disallowed. Then we now move further to now look at other things that we need to know. So we now go straight to the aspect of deferred taxes. I also mentioned how we can for that interest expense payable. I also gave us this illustration to tell us about somebody that issued out a 10% debenture. And when you have 10% debenture, this debenture now, the person that is going to subscribe to this debenture, you are telling the person you are going to pay the person 10% of whatever amount he's subscribing for. So the interest that you are paying this person is going to be 10% of 500,000, which is going to give us like 50,000. Now, this interest is an expense, right? That you are going to pay that person for giving you your money to use for that period. However, don't also forget that as at the time you are preparing your account, probably this interest you have not paid it, though it could be due already, but you have not paid it. So what do? You discover that you are having interest expense payable, but you have not paid it. So if you go to the account, it's going to look like an accrual. It's an accrual. You credit your accrual account because you have not paid it, but you now go to the financial statement, the profit and loss account, you are creating a provisions for it, you debit profit and loss account. So the taxman will not allow this thing as an expense. The reason is because you have actually not incurred it yet. You are still owing that person 50,000. You have not paid it. But because accounts are done per period, okay? Per period, they do account per period. So you just say that, okay, since we borrowed that money in 2021, and since that interest, we ought to pay it in 2021, but we have not paid it. Probably there is no money to pay it yet. So we ought to pay it in 2021. So if we are doing account for 2021, we also go and recognize all expenses that we feel we have incurred in 2021 that we feel that should be paid in 2021, even though we have not paid them. We go and put them in our financial statement. So that is how to create provision. Now you discover that this amount, you have not actually paid it, but you're going to charge it in the financial statement as though you have paid the expense on it. So that is going to be an issue, and the taxman is not going to allow it. He's going to disallow this amount. But in the future, when you now eventually pay it, it's going to allow it. Okay, but for now, because you have not paid it yet, because you have not paid it, it's going to disallow it. Then we went further to now look at what we call deferred taxes. We told you that deferred taxes are taxes that either you underpaid or you overpaid. So it's not going to create a liability for you in the future, or it's going to create an asset for you in the future. For instance, let's say you want to pay tax for 2025. We normally pay it the second year, which is we are supposed to pay it in 2026. You discover that this tax, you have your own computation that your accountant has prepared or calculated for you. Now, that tax that the accountant has calculated, the accountant will go on and pay it, right? However, the taxman is also going to do his own computation, taking your own accounting profit, adding back all disallowable expenses, lessen the allowable expenses, and then it's going to have your taxable profit. So it's on that taxable profit that the taxman is going to charge the tax rate. Okay, so you discover that whenever you have deferred taxes, is a situation whereby the tax that you computed based on your accounting profit is actually different from the tax that the taxman is talking about. Another thing that causes this difference is what we call your carrying amount versus your tax base. We looked at it the other day. We said that your carrying amount is always gotten when you say the cost of the asset minus your accumulated depreciation minus your accumulated impairment losses. So whatever you get, that is what we call carrying amount. So the taxman also will go and calculate his own. The taxman will say the cost of the asset minus the tax base of that asset. So after he has done that, he's going to get an amount that is remaining from that asset. So let me quickly do it here so that it doesn't look like I'm speaking jargons. So I said one of the things that cause this temporary difference is what we call the carrying amount of an asset and also the tax base of that asset. So when we come over here, we now say, we do something like this. We say deferred taxes are usually caused, okay, that is CUASE, caused by the differences between the carrying amount of an asset and its tax base. Okay, so what is carrying amount? You already know carrying amount. Okay, so let me now make this, let me put this one down. Yeah, so definition of terms. So now, deferred taxes are deferred. Okay, it's the one F, and we have double R, one F and double R. It's fine. So deferred taxes are usually caused by the differences between the carrying amount of an asset and the tax base of that asset. Fine. So that is what is happening. Then how do we know what the carrying amount of an asset is? So carrying amount equal to the cost of the asset, okay, minus depreciation minus accumulated impairment losses. So that is how to get your carrying amount. Then what is your tax base? Your tax base is let me see, hold on. So to get your tax base, we come down here, we say tax base is equal to the cost of the asset, right, minus capital allowance. So I just felt I needed to just do this. I needed to do this so that we can understand what we are doing. So whenever you have a carrying amount that is different from the tax base of that asset, it's always going to cause a temporary difference. There's always going to be a temporary difference. And we're also able to look at it the other day in details. So now here, under here, we're looking at definition of terms. I want to go straight. So the first thing on the list is tax base. The tax base of an asset is the amount attributed to that asset as liability. So the amount attributed to an asset, the tax base of an asset is that amount attributed to that asset or a liability. So the amount that you attributed to the asset or the amount that you attributed to the liability. How do you get that? You say the cost of that asset minus the capital allowance. So we get what you call your tax base. So the amount you attributed to that asset or liability for tax purpose by the revenue authority. Then the next one we talk about carrying amount is the amount at which an asset is recognized on the face of the financial statement after deducting accumulated depreciation and accumulated impairment losses. Now, what does this difference between carrying amount and tax base, what does it cause? It usually causes what we call temporary difference. So what is temporary difference? Temporary difference, they are temporary differences that would result in taxable amounts in the future. Okay, so temporary difference, they are the kind of difference that will result in taxable amounts or deductible amount in the future. So how does the differences come? It comes by comparing your carrying amount and your tax base. So that is where you discover what that difference is going to be. So that kind of difference is either going to cause a taxable amount in the future or it's going to cause a deductible amount in the future. So that's what we call taxable temporary. Am I looking at taxable temporary difference? Oh, sorry. I thought I was looking at just temporary differences. Okay. So temporary difference now, that is what is going to so temporary difference is the difference between the current amount of an asset and its tax base. Fine. Then the next one, once you understand that the temporary difference is the difference between the current amount of an asset and its tax base, then we'll now go to look at taxable temporary difference. So this taxable temporary difference, as the name implies, is going to cause a difference that will result in a taxable amount in the future. So most times, when you're having a taxable temporary difference, it always occurs when your carrying amount exceeds your tax base, when the carrying amount of an asset exceed the tax base of that asset. So it's going to cause a taxable temporary difference. Number two, we talk about deductible temporary difference. So when do we encounter a deductible temporary difference? Deductible temporary difference are encountered when your tax base is actually higher than the carrying amount. So when the tax base is higher than the carrying amount, what you're going to have is what we'll call the deductible temporary difference. Now, the next thing, we'll go straight. What are deferred taxes? Now, when we have all these temporary difference, okay, just take your tax rate and use it to multiply the temporary differences. When you take the tax rates that you have in the question, you need to multiply the temporary differences. You're going to get what we call a deferred tax. So what are deferred tax? A tax that is arising when the tax rate is applied on the temporary difference. So that is when we have what we call a deferred tax, when you apply the tax rate on the temporary difference that we've gotten. Now, when do we have a deferred tax liability? You know, as the name implies, a liability, okay? When you're having a taxable temporary difference, when your carrying amount is higher than your tax base, it's going to create a liability for you. You are going to have a taxable temporary difference, which when you take the tax base, which when you take the tax rate, you need to multiply the difference that you get. You're going to get what we call a taxable. You're going to get a deferred tax liability. So I said most times is when your carrying amount exceeds the tax base of that asset, is going to create this deferred tax liability. Then the last one is deferred tax asset. Always occurs when it's your tax base that exceeds the carrying amount. So now we have already seen what carrying amount is, which I've explained to us. We've also seen what the tax base of an asset is. Fine. Let's now go further to look at the first illustration in the topic. Now, we've looked at this illustration the last time. I don't feel I will need to waste time on these again because we've looked at it before. We've treated it before. So I said, when you have this kind of question, all you need to do is compare the carrying amount and the tax base. So let's quickly go down and look at the solution. We simply say 40 minus 25, we got 15. 10 minus 14. So you see 10. Now, what you're always doing is you're saying the carrying amount minus the tax base. So we say 40 minus 25, you're going to get a positive 15. 10 minus 14, you're going to get a negative 4. So when you have a positive figure, the figure is not favorable. When you have a negative figure, the negative figures, they are favorable. So when you add this together, when you say a positive 15,000 plus a negative 4,000 plus a negative 2,000, yeah, there is no difference here. 16,000, 16,000, no difference. 5,000, 5,000, there is no difference. So you discover that at the end of the day, when you add everything together, you're going to get a positive figure. Whenever you have a positive figure, it's not favorable. A positive figure is not favorable. It's showing us that we have a liability. Whenever the figure is positive, it shows us that we have a liability. Yeah. Yeah. I hope we are following.
Yes.
All right. So that is that. So we now go further. So once you have a positive figure, is not favorable because the positive figure is actually saying that we have a liability. That means that the tax that we paid previously, we didn't pay enough. We need to pay more. So when you now take the the tax rate that is applicable in the question, you multiply it on the positive figure that you get, it's going to show the tax that you are to actually pay, the extra tax that needed to be paid. Okay. Uh, Now we are going to continue now, and we are going straight. I've done all this last time. We've done all this as well. So I also let me quickly reiterate what we said we have to do here. Whenever you are having this kind of scenario, okay, whenever you're having that kind of scenario, this is what you need to do. When you have the carrying amount of an asset, and when they also give you the revalued amount of that asset, okay, whenever you are giving the revalued amount of an asset, pick the value amount of an asset, leave the carrying amount. So now, we normally compare the carrying amount of an asset with the tax base. But in a question whereby you are giving the revalued amount of an asset, please do not continue with the carrying value. Rather, go for the revalued amount. It means that the amount is certain amount in our books, but they call a valuer. The valuer has revalued that amount. Okay. So since the amount has been adjusted for, don't go with the old amount. Simply go with the new amount that they've gotten. So revalued amount is always what you are also always going to pick at every point in time. So you now compare your revalued amount, compare it with your carrying amount, and that is what we did over here. So we're not going to wait there. We are going straight now to this tax expense to recognize in the statement of profit and loss. The tax expense to recognize in the statement of profit and loss. So what do we mean? What are we trying to say? In this kind of situation, you discover that you've already discovered what your current tax is. To get your current tax, can somebody tell me how do you get your current tax? Can somebody quickly tell me? Hello, you're on the call. You understand current tax? You understand what I've been saying? Explain to me, how do we get current taxes? Who can explain? Who wants to try? Who wants to try? Everybody's quiet now. So I said to get current taxes, to get the current tax that you needed to pay this year is by saying, how do I calculate the tax that the taxman is going to say I need to pay? So that's the current tax. Already you've calculated, you have your accounting profit. which you have over here. So that your accounting profit, you have used it for your tax computation. But with the taxman, just go with your own computation? No, the taxman is not going to go with your computation. The taxman will come and calculate his own tax by taking your accounting profit that you have. He's going to add back all the disallowable expenses. Then he's going to less allowable expense. Then at the end of the day, he's going to have what we call taxable profit. So it's on this taxable profit now that the taxman will now multiply by the tax rate. So when you take your taxable profit, you multiply it by your tax rate, you are going to get the current tax. So that's how to get current tax actually. So to get your current tax, that's how you're going to get your current tax in the first place. Okay, so that's how you're going to get your current tax in the first place. So when I
Sorry, you said how do we get current tax?
all right, so to get your current tax, you've calculated. So this is what you do. This is the process you need to do. The first thing, take your accounting profits, which you are likely to be given in the question. Once you take the accounting profit you are given in the question, you add back all the disallowable expenses. That means that in that question, you are going to go and start looking for all these disallowable expenses. One of the disallowable expenses is what we call depreciation charge. The depreciation for the year is not allowed. Deduct it. You add it back. Sorry, because you are going to add back. Initially, you would have deducted because depreciation was treated as an expense. Was treated as an expense, though it does not involve movement of cash. It doesn't involve movement of cash. So, for instance, I bought my motor vehicle in January. So when I bought my motor vehicle in January, I have that motor vehicle parked in my garage. Okay, and now I'm now saying, okay, because I use this motor vehicle for carrying goods for this company, for my company, okay, then I now said that, okay, I'm going to be charging, I want to reclaim that the expense I incurred when I bought that vehicle. Okay, maybe I bought the vehicle for, let's say, 30 million. So because I bought the vehicle for 30 million, I feel that I needed to charge that expense on my business. Okay, I need to charge the expense on my business because the vehicle I'm using it for my business. Okay, so I feel that I needed to charge that expense on the business. But the taxman is saying, calm down, calm down. We know that this expense, you've actually incurred it. We know. But how many years is this vehicle going to last you? You say, okay, the vehicle is going to last me for 10 years. So why are you charging it why are you charging all the expense in only 1 year? When the vehicle is going to last you for 10 years, why not spread that expense over the 10 years time that the vehicle is going to be useful to you? Okay, so you now say, okay, instead of me to charge that vehicle, that amount, the vehicle is going to last me for 10 years, right? Instead of me to now charge that expense in only one accounting year, okay, why not spread that the expense of that vehicle, why not spread it for 10 years so that you charge each portion yearly for that 10 years. So now you discover that even when you are charging the first year, the motor vehicle is still in your garage. Nothing has happened to it. It's still a old vehicle. Okay. So they now say that this motor vehicle, the depreciation you are charging is not a cash item. In fact, it's something that is an expense that you have incurred in the past. Now you're only recognizing it now. So it's not like as if money is moving away now. Money is not moving away now. You have already incurred it already, but you are just coming to charge it now. Imagine a motor vehicle that you purchased in 2020, and then because the motor vehicle is going to last you for 10 years, you spread the expense over 10 years. So you discover that in 2021, you are recognizing a portion of that expense, but that expense you are recognizing at that period is not as if you just incurred it now. No, you have incurred it in 2020. So you're only recognizing it now. So it does not involve no extra cost. No money is moving out, even in 2021. No money is moving out in 2020. Every money that moved out was in 2020. So they say depreciation is not a cash item. And also another thing is that I also told us that the depreciation method that is used is different for different companies. Some companies may decide to use reducing balance method. Some company may decide to use some of the year digits. Some company may decide to use straight line method. There are different depreciation method. Okay. However, the taxman does not recognize depreciation. In exchange for depreciation, the taxman recognizes what we call capital allowance. There's a rule that is used when they are calculating capital allowance. Now, the next thing we are looking at is, apart from depreciation, what else is not allowed? Provisions. Provisions for anything that has not crystallized, anything that has not happened, any provision you are creating for it, the taxman does not allow it. So if you create a provision for bad debt, how do we normally create a provision for bad debt? So this bad debt now is our customers that we have, they are owing us. Okay. So these customers are owing us, and because they are owing us, we now say that, okay, out of this customer that are owing us, we assume that some of them will disappoint. Okay, we are just trying to be proactive. We are trying to like be proactive. What if some of them disappoint us? So we now say, okay, let's go and create a provisions for those people that we may likely disappoint. Okay, so when a customer disappoints us, does not pay us again, we have lost that money. So in accounting, the accountant does not want to lose anything. Whether you make a loss for that period, you are still going to go and reduce it from another profit of another period. So the accountant does not want to make a loss. Company, they don't want to make a loss at all. Companies, they are in to make profit. So when you come here, you have these provisions for bad debt. The bad debt has not occurred. None of your debtors as none of your debt has become bad. So when a debt becomes bad is when you are no longer able to collect it, but none of the debt has become bad. So why are you creating a provisions for bad debt? So it becomes a challenge, and they are going to disallow it. They will disallow it. So another thing they also disallow is donations. You make donations to any unrecognized organization. Okay, if you make any donation to political party, you make any donations to any organization that is not recognized. But if you make donation to organizations that are recognized, such as Boys Brigade, Boy Scout, Red Cross, all those ones are allowable. They're allowed. But if you now make any donations to Baba Jebu, for instance, you make donations to Baba Jebu, you make donation to any church within church, make donation to a mosque, make donation to all those things are not recognized. Make donation to political party to fund one political party. What do they call them now? Uh, Candidate is not allowed. So any donation that you made that is not recognized in law is going to be disallowed. Then the last one I told us of interest expense that is yet to be paid. So any interest expense that is yet to be paid, they call them accruals. Okay, they are accrued expenses, expenses that are due but are yet to be settled. Okay, so you have accruals, and this interest expense is one of them. If you have any expense, interest expense that you're owing, but you have not paid, but you come to your financial statement and you already captured it as if you have paid, the tax man is going to disallow it. Okay, so those are this. So when you are trying to get your taxable profit or your current tax, okay, you simply get your taxable profit by going through all this route. Once you get your taxable profit, then you now say your current tax equal to your taxable profit multiplied by the tax rate. So let's do that here. So once we're done with this, we now say we now come here, we now say current tax equal to your taxable profit that you've gotten, taxable profit, the taxable profit multiplied by the tax rate, multiplied by the tax rate. So this is how you get your current tax for the period. I hope this makes sense to us. Do we understand? Do we understand?
Yes.
Yes, understand.
All right. So I hope nobody is sleeping on the call. So I hope nobody is sleeping on the call. You know, my voice can get so sweet at times that you can just fall asleep. Just joking. Okay, so let's continue. Yeah, let's continue. So we are building up on our knowledge. And one good thing about the way I teach you is this. I teach you not to only pass your exam, I am teaching you for you to apply it in real world scenario. So if you're working in an organization, for my lectures, you should be able to know how a lot of accounting transactions are treated. I take my time to explain them to you so that even when you get to workplace, we can easily replicate what I've taught you. Okay, so we've done all these, right? We are building on our knowledge. Now, the next stage we are going to now, we are now looking at what is the tax expense that is always recognized in our statement of profit and loss. You see that they prepare an account. Let me go and check an account, for instance. Let's go down to, there's another topic that we're going to treat that is also very interesting. That topic is what we call cash flow statement. So let's go down to that section where we have our cash flow statement, and let's see. So this is a cash flow statement. We're going to treat it, and it's always prepared in our in account. So you see that they say the account that you have to prepare. I think there are 5: directors report, auditors report. We talk about statement of profit and loss, another comprehensive income. We talk about statement of financial position. We talk about cash flow statement. You talk about value added services. We talk about, oh, there are lots that you can prepare. So this one is a must. Okay, this is a topic that we're going to look at. Okay, and then we are going to make good use of the opportunity. Any topic I'm teaching you, I'm not only teaching you for you to pass your exam, I'm also teaching you for you to apply it in real life. So I just want to go down to look at a financial statement, and then I want to show us something in that financial statement. Okay, I want to show us something in the financial statement, and let me see. Okay, so this is like a financial statement now. So here we have the statement of financial position. When you have the statement of financial position, we are talking about all your assets, your liabilities. So the assets that is owned by an organization versus the liability that the organization owes, that is going to be found in the statement of financial position. But when I go to the statement of profit and loss and other comprehensive income, this is where we're going to see the revenue for the period, which I told you that you are going to have. So this is what is happening in your account. Okay, you have done the revenue for the period the sales that you made. Then you less the cost of sales. After lessing the cost of sales, you're going to get what we call the gross profit. The gross profit. So when you get the gross profit, then the next one, you talk about distribution cost. What are the costs for distribution? Maybe you are carrying you are going to supply all those goods at different locations. Okay, they call it distribution costs. Then we have what we call administrative expenses. Okay, administrative expenses, salaries that you paid to your managers, and so on and so forth. After that, we have what we call the finance cost. So this finance cost now is that cost that this is your interest expense that I was talking about. So finance cost is that cost that you incur because you borrowed a loan. Okay, so finance cost is an expense. Okay, now the next thing is, after you've done that, when you minus your all the expenses, distribution cost minus administrative expenses minus your finance cost, which is your interest expense, at the end of the day, you are going to have your profit before tax. Then you now come and say, what is the tax payable? So this tax now is what we are trying to look at. So this tax is what we are looking at. What is the actual tax that we need to capture? For those, you see the auditors, when they prepare their account, they are going to show you the tax provisions, for the tax that they want to pay. Now, because the auditors, they are certified people, they are professionals. Okay, instead of them waiting for there to be back and forth, you therefore prepare your accounting profit anyhow, and then the tax man needs to now be compute and then send back to you that you have a deferred tax or anything. the auditor will create a provisions. Okay, we create a provision. So those provisions are going to be in the account. Then they are not the actual tax that they actually pay. These are just provisions. At the end of the day, they're going to have the profit for the period. So this profit now is what we call the accounting profit. Okay, so this is the accounting profit. This is what the auditor will, sorry, this is what the tax man will take. The tax man will take this thing and go and now we calculate, use it to work back and get his own taxable profit. So I'm just trying to show you all this. So what is now that tax that they always recognize in the actual audited account? So in your audited account, there is a profit that you normally recognize, or in other words, the tax that you ought to pay. Okay, the tax that you ought to pay, how do you recognize it? You already know how to get your current tax. You know that your current tax is gotten by saying the tax that the tax that the auditor computes times the tax rate. That's how to get your current tax. So let's look at the tax that is always, look at the expense, the tax expense to recognize in the statement of profit or loss. So this tax expense to recognize is what we call, the tax expense to recognize is the current tax, okay, that is calculated, plus the movement in deferred taxes. Current tax that you've calculated, plus the movement in deferred taxes. And this topic is actually technical, but it is very interesting. If you can listen to it very well, you are going to become an expert in this. And I also told us that whenever I'm also teaching us, I'm not only teaching us to pass this topic, I'm also teaching us to apply it in real life. It means that when you get to higher classes, when you get to skills level, or you get to professional level, if they are talking about IAS 12, you already have a solid grasp of it. You have no issue. You are not shaking. You already know that, okay, whenever they talk about IAS 12, I understand it fully. Okay, so whenever they now come up with it in the future, it's just going to be like a vision for you because I've dealt with it well in the class. So look at it now. We have the tax expense to recognize is always going to be the current tax, which I told us how to get. It's going to be the taxable profit multiplied by the tax rate plus movement in deferred taxes. So we already know what a deferred tax is. I told us that is the tax rate multiplied by the temporary difference. That's how you get deferred tax. So this deferred tax, we can get a deferred tax liability, we can get a deferred tax asset based on the differences that we have between our carrying amount and the tax base of an asset. Okay, so it can give us the kind of deferred tax that we have. So let's now continue. Let's assume we are trying to get the current tax. How do we get it? We simply say let's assume our tax rate is actually 30. Our tax rate is 30%, right? So if our tax rate is 30%, what do we have as our I'm coming. Okay. Yeah, so I'm coming. I'm trying to see what just hold on. Yeah, so if we have this kind of deferred tax, sorry, the current tax is always 30% of our taxable profit. So how do you get back your taxable profit? We now say this amount, which is the 30%, we now say to work back, we say that 100 divided by 30 times this amount, 30,600, and we're going to get 102. So to get our taxable, what they use here, the taxable profit they use here is so let's say to get our current tax, we say taxable profit multiplied by the tax rate. So multiplied by the tax rate. So which is going to be like to say is the same thing as saying equal to, is it 100 and let me see hold on, I'm coming 2 4 5 7 1 4 2. Okay, so yeah, 102,000 1 2 3 multiplied by 30% is going to give us this value that we have over here. So this is how we got our current tax. So this is how we got our current tax. So to get the tax to recognize, we are saying our current tax payable for the period, right, which is this, plus the movement in deferred taxes. So we already know what deferred tax is. Deferred tax is going to be so to get a deferred tax. So let's come here. So deferred tax is equal to temporary difference times the tax rate. Okay, so this is how we get our deferred tax. Okay, so temporary difference times the tax rate, and you know how to get the temporary difference when we minus when we look at the difference between carrying amount and the difference between. So let me say temporary difference. How do we get temporary difference? So temporary difference equal to carrying amount minus tax base of an asset. So tax base, so that you get your temporary difference. So that is fine. So we already know that to get our current tax, we say our taxable profit multiplied by the tax rate, which is what we've done over here, and then we've got something. So now that's so we are building on our knowledge. So they say the actual expense to recognize in your financial statement, in your statement of profit and loss, the audited account, the actual expense to recognize is always gotten by saying the current tax for the period plus the movement in deferred tax. So why are we calling it movement? Movement in the sense that you could have deferred tax that you are bringing from last year. You could also have deferred tax for the period. Okay, so you could have deferred tax that you are bringing from last year. You could also have deferred tax that you have in the period. So that is how to get that, the movement in deferred taxes. All right. So we are going to continue. We are going to build more on this knowledge. And I believe that we are going to gain a lot. Right. We're going to gain a lot. So let's move further. I'm coming on. Yeah, so what are we now looking at? So I've explained all this for us. I just wanted us to digest them so that it doesn't look like I'm rushing us or something. So yeah, we now come further. We now say that in the trial balance, if you have a deferred tax of 2,700 on the credit side, it's a deferred tax liability. So you know that liabilities are always on the credit side, right? So now let's look at accounting, whatever. When you have, let's look at all these things. So account types, or let's say element of accounts and their balances. Okay, so accounting balances. So let's come over here, under here, let's quickly treat that. So we can say the element of account, the elements of account. So I think we have 5 elements of account. There are 5. So in bracket, we have 5 of them. Okay, so the first one is what we call number 1, we have assets. So we have assets. Asset is one of the elements of the financial statement. We have asset, elements of the financial statement, or element of your account, elements of financial statement, financial statements. So there are 5 elements of the financial statement, and these elements are what we also use when we are trying to create our chart of accounts. So the first one is asset. They always have debit balances. So asset always have debit balances all the time. Asset will always have debit balances. Number two, apart from asset, we have expenses. So expenses, we also have debit balances. So these two, they are having debit balances all the time. So all the time, expense is always debited, and asset is always also debited. Okay, so that is that. Now, we also have losses, but we don't want to. Let's just deal with only the 5 elements of account. The next one we have is income. We all know what income is. Income slash sales slash revenue. So they are the same thing. Whenever they are talking about income, they're talking about they're talking about sales, they're talking about revenue, they're referring to the same thing. So income or sales or revenue, they always have credit balances. Okay? So they always have credit balances. So I'm going to shift this one from here. I'm going to move it all like this, okay? Here as well, I want to align it to, yeah, okay, fine. It's making sense. Now, the next thing is that apart from these sales, this income, this revenue, we also have what we call liabilities. Liability, or liabilities, as the case may be. So under liability, you have loans, you have whatever. So liability. So they also have credit balances. They also have credit balance. And lastly, last but not the least, is what we call equity. The same thing that some people call capital. It always have also credit balance. Okay, so that's fine. So now we already know that these are the element of accounts, which we also use when we are creating our chart of accounts. So, but we're not in accounting training class, so I may not delve into that. But I just wanted you to have this knowledge first before we now come over to now start looking at our movement in deferred taxes, because you really needed to know how we are getting all this. So this is deferred tax. Deferred tax, whenever it's on the credit side, is representing a liability, because a liability is always having a credit balance. So deferred tax, when it's on the credit side, is representing a liability. So we are saying that in the trial balance, if you have a deferred tax of 22,700 on the credit side, that is a deferred tax liability. Okay, so in your trial balance, that is what you have, right? Now, then I say that, and in the additional information, so you are going to see a financial statement, a question they're going to give you. They can give you a trial balance, they can give you notes to the account. So they can give you note to the account, or they can give you an account and also give you notes to the account. So they're going to go to the notes to the account to check what is the deferred tax for the period. What is the deferred tax that you calculated? I've taught us how to calculate deferred taxes. So when I come here, we check. They give us already an opening balance in our trial balance. They can tell you that your deferred tax that you have from last year is on the credit side, which means it's a deferred tax liability. Now this year, they will not give you information to calculate deferred tax for the period. So how do you calculate that? Look at the carrying amount, the difference between the carrying amount and the tax base. We give you the kind of deferred tax that you're going to have. Are you going to have a deferred tax asset, or are you going to have a deferred tax liability? So when I come here, they say in the additional information, you are giving a temporary difference to calculate. You are giving a temporary difference to calculate the deferred tax. And after calculating, you got a deferred tax liability of 600. So I'm just giving an illustration. Let's assume in the question they gave you already in your trial balance, they're giving you this balance. So your deferred tax assets, the deferred tax is on the credit side to indicate that it's a liability, right? Then they also now give you information that can help you to calculate temporary difference. Okay, and those temporary difference, when you multiply it by the tax rate, you're going to get a deferred tax, either asset or a deferred tax liability. So when you have calculated that, probably you now got a deferred tax liability of 600, meaning the carrying amount exceeds the tax base by 1,500, resulting in a taxable difference. Then apply the tax rate to get the deferred tax liability. So let me show us, because majority of us may not understand what I'm actually saying. Okay, so let me prove it to us, because people will say, they're just giving us figures. Where are the figures coming from? Okay, you don't know where the figures are coming from. You are not sure, and because of that, you are confused. So let's put figure to them. Okay, let's put figures to them. So remember, you're going to be giving let's go up, let's copy something to make it easier for us. You're going to be giving something like this. You're going to have the kind amount. You're also going to have something like this. So let's see. So let me just copy this, right? Let me just copy this like this, like this, like this. Fine. We come right over here. Let's come right over here in between this question. Okay, so we are here right now, and then we want to put something here. Yes, let's put it here. Let's put it here. So Ctrl V. Now here, you already have the kind amount of an asset to be. I'm coming. Give me 2 minutes. So they are going to give you the kind amount of an asset. They're actually going to also give you the tax base. Okay, so let's check. Let's say we have property, plant, and equipment. They gave you. I'm coming. I want to check something. I want to check something. Let me check for something. I want to see what I can change to achieve what I'm looking for. So I say that 600 is going to be as a result of saying that 600 is like 30%. 30%. So we now say that 100 divided by 30 times 600, we are going to have 2,000. How come? 2,000. What? Yeah, so we with the assumption that we are having the tax rate of 30%, okay, we want to get what we call 2,000. So what we do is that instead of us having this amount, I want to reduce this figure. I want to increase this one. So here we have 6,000. We need 6,000 extra. So I want to reduce this. So I want to make this one like let's say it should be like 9,000 more. So if you say 25,000, 25, 2, 4, 5, 7, 1, 4. So 25,000 plus 9,000. What? 9,000? No. Plus 6,000, sorry. Plus 7,000. Yeah, 7,000. 1, 2, 3. We're going to have this. So let's change this one now. We'll change this one to 32,000. So this is going to be 32,000. 32,000. So when you take your 40 minus 32 minus 32,000, you're going to have something like 8,000 here. So here is going to be 8,000, right? So here is going to be 8,000. So we come here, we come and put 8,000 here. So you already understand. Please unmute your mic. I want to be sure that we are following. Do you understand this thing I'm actually doing, so that it doesn't look like I'm talking to a class that does not understand what I'm doing? I'm sure majority of us were in the last class, and I took my time to explain how to calculate deferred tax for us. Please unmute your mic. Everybody, unmute your mic. Everybody. Were we in the last class?
I wasn't in the last class.
Yes, sir.
Okay, so some people were in the last class and they understand what is going on. why some were not in the last class. And is it possible that I've not shared the recording for last class? I don't want to believe that. I should have. I didn't share the recording. Hello?
No, no, sir.
Oh, I didn't share it. Oh,
Hello, good morning. Sorry, I'm just joining today,
okay.
and I don't know if I can get the recording for the last classes that we've done.
Okay. Thank you. So what you need to do, somebody should just go in the group and just remind me to drop the recordings for the last class. I'll do that. So now if your mic is okay, I said we should unmute our mic. Okay, so that is fine. So let's go back to our sheet, because I don't want to teach you with the hope that you are following and then you are not following. So I'm trying to teach us the tax expense to recognize, and this is going to be a very technical aspect. So I'm taking my time to break down everything that I know can be challenging to you, so that I want you to understand it like ABC, just like adding 1 and 2 together and you get your answer. And that's what I want you to do. So now here I want to recap how to calculate your deferred tax. I told us that to even get deferred tax at all, there must have been a temporary difference. How do temporary difference occur? Temporary difference occur when you are looking at the current amount of an asset, you are comparing it to the tax base. And I also told us from last time, I said whenever you are doing that, they're going to give you the current amount of the asset. And if they don't give you, you can also go and calculate it yourself. So if they want to stress you, they will not give you the carrying amount. They'll give you an asset, right? So I've already told us how to get carrying amount. I say it's the, okay, can somebody tell me how do we get carrying amount? Who can quickly tell me that on the call? Carrying amount.
Is the cost minus accumulated depreciation minus accumulated impairment loss.
Thank you very much for that. So to get the current amount of an asset, you say the cost of the asset minus accumulated depreciation minus accumulated impairment losses. That's how you get the current amount. So at times they may not give you the current amount. You might need to go and calculate it yourself. And it's important for you to know how to calculate it. And that is why we first did IAS 36 before, which is talking about impairment of assets. Under IAS 36, we've dealt extensively with a lot of concepts in account. Okay, we've dealt extensively with it, and I believe that a lot of us, we already know a lot of things that I'm talking about. So there's no way you'll be in my class that you will not improve in your accounting. Okay, so now here we continue. Now when you are trying to get, now you know we already have in our trial balance that they give us, we already have, they've posted something. They showed us that on the credit side, there is a tax, a deferred tax, to show us that this deferred tax is actually a liability. Okay, so now they've given you the deferred tax, and this deferred tax should be deferred tax from last year, prior period. Okay, maybe last year. Now, this year, now they now gave you information that can also lead you to computing the deferred tax for the year. So what do? They are going to give you carrying amount of the asset, or if they don't give you the carrying amount of the asset, they will give you the cost of the asset. They will give you information to calculate depreciation. So when you are giving the cost of the asset, you should be able to calculate depreciation. I also taught us how to do depreciation from the last period. Also, I taught us depreciation and all that. Then you should be able to get the kind amount, because kind amount is always saying the cost of the assets minus the accumulated depreciation minus accumulated impairment losses. Don't let it scare you. Accumulated depreciation is just depreciation that for different period that they add together. Maybe depreciation of year 1, year 2, year 3, year 4. When they add everything together, it becomes accumulated. So accumulated depreciation. So we could have an asset that we purchased in the year 2020, right? And then we could have been depreciating the asset up till now. So what they normally do in accounts is that they normally take the cost of the asset at every point in time. And in year 2020, you take the cost of the asset, you minus depreciation from it to get, if there is impairment losses, you minus it to get what your carrying amount is. You are in year 2, you also take that cost of the asset, okay? You now minus depreciation that you charge in year 1, and the depreciation that you are charging now, so it becomes accumulated. So that's why they say the cost of the asset minus the accumulated depreciation, then minus the accumulated impairment losses. So even when you get to year 3, you also want to show the carrying amount of the asset. You still go and take the cost of that asset minus the accumulated depreciation you charge in year 1, minus the depreciation you charge in year 1, minus the depreciation you charge in year 2, because we're in year 3 now. You also now minus the depreciation you are charging in year 3. So that's why they say the cost of the assets minus accumulated depreciation and accumulated impairment losses. So here now, they can give you a question. In that question, let's go and check that question that we are treating that made us to pick this information. So no, not this one. I think, is it this one? I think so. Okay, so let's quickly look at this one. They say, Kofia Dome Limited has the following assets and liabilities. You can mute your mic now. Everybody mute your mic now. Thank you. Everybody mute your mic now. Somebody's mic is disturbing us. Or, oh no, it's not somebody's mic. Okay. So I think it's a vehicle that they are trying to, is making noise from outside. So yeah, we now have a question. I want you to understand it. They say Kofia Dome Limited has the following assets and liability in its financial statement as at 31st December 2024. So yeah, they gave us the carrying amount. It was given to us directly. However, they may not give us directly. You can go and calculate it yourself. If you don't know how to calculate it yourself, go and see the other video that I did that is talking about IAS 36, impairment of assets. Go and check that video. So here we have the property, plant, and equipment of that. Okay, we have the kind amount to be this amount. Then we also have what the taxman is also having. Now you know that the taxman is actually different from the accountant. The accountant is using depreciation, right? While the taxman is going to be using capital allowance. Okay, so now now we now got, sorry, so we see that in our books we are having 40 million because there are 3 zeros up. We're having 40 million. However, the taxman in his own book, the record he has for our asset is having 25 million. Okay, so that means there's a difference between what we are having as the cost of the asset and what the taxman is having in his book. There's going to be an issue because what does it mean? When we want to calculate depreciation on this thing, okay, we now take this 40,000, we divide it by, let's say it still have a useful life of 4 years. We divide this 40,000 by 4, then it means that each year we're going to be charging 10,000. So you discover that this year we are charging 10,000 as expense, which is going to reduce your profit. However, the taxman divides this 25,000 by 4, and then he now charge it to your profit. So you discover that in your when your carrying amount is higher, your profit is going to be low. It's going to be low. Okay, so let me not make it more complicating again, but let's just move on. So whenever you are trying to get deferred taxes, compare the difference between a carrying amount and the tax base. So when you compare it, that difference, okay, you're going to have it here. It's a temporary difference. So if that difference is a positive one, always take the carrying amount first. Take the carrying amount less your tax base. So price it in your calculator equal to 40,000 minus 25. You're going to get 15,000 positive. If you also come here, the carrying amount of this asset is 10,000, while the recoverable amount is 14,000. So if you take your calculator, press 10,000 minus 14,000, you're going to get a negative figure. So that's how you should do it. The next year, take your 6,000, press it in your calculator, minus 8,000. So always take the carrying amount first. Always press the carrying amount first in your calculator before you minus the tax base all the time. So some will be positive, some will be negative. So whichever is positive is not favorable. Whichever is negative is what is favorable. So when you now add everything together, you're going to get what the difference is. So when you say 15,000 plus, sorry, the 15,000 minus 4,000 minus 2,000, you're going to be getting a positive 9. And when you get a positive figure, it's unfavorable. It means that it's a liability. It's going to create a liability for us. So which means that we're going to pay tax in the future. Okay, so that is what we did. You now take this amount, multiply it by the tax rate. Okay, you're going to get this value. So this is how we got our deferred tax for last year that we brought into our book. So that we brought into our book here, that we brought into our book, that we brought into, hold on, yeah. So that's how we got that we brought into our book. So it's not magic. This is what we brought into our book. Okay. Now this year, now they are not giving you similar assets, right? The similar assets you are giving, you are not told that okay, or let's change it. Do we change it? Do we change it? Do we change it? Minimum. Okay, let's just leave it. So when I say yeah, we'll say 40,000 minus 32. What are we going to get? We're going to get 8. Am I right? Please confirm it. Everybody confirm it. 40,000 minus that. What are we going to get? Hello?
8,000.
8,000. Beautiful. So now the next one, we now take 10,000 minus 14,000. We're going to get 4,000. 6,000 minus 8,000. We're going to get 2. 16 minus 16 is 0. 5 minus 5 is 0. So when you now add together, 8 positive minus 4 minus 2. What are you going to get? You're going to get 2,000. Am I right?
Yes.
So you're going to get 2,000 here. So when you have 2,000 here, so it's also positive. It's also positive. So which means it's also a liability. So we now say the 2,000 multiplied by our tax rate. So let's say 2,000 times 30%. What's our answer? 2,000 times
600.
Is what?
600.
Oh, beautiful. So it's 600. Okay, so 600. 600. Yeah. So that is how they got the 600 that is here. So meaning the carrying amount exceeds the tax base by 2,000. So not 1,500, sorry, by 2,000. Oh, what am I doing? So exceed the tax base by 2,000. So we come over here and we come and put another 0. Then here we put 2 here. So that's fine. So now that is how we're able to get our answer. So here is actually 600 and not 27 any longer. So let me delete this. So this is 600. So I come and put 600 here. So you can see the way it flows, right? So they say that after calculating, you got a deferred tax liability of 600, meaning the carrying amount exceeds the tax base by 2,000, resulting in a temporary difference. Then apply the tax rate to get the, oh, yes. Yeah. So now when you get this temporary difference, you now apply the tax rate to get the deferred tax liability of 600. So note, where whatever deferred tax you have in your trial balance relates to last year, prior period. Therefore, the movement in deferred tax is this. Scenario 1, last year deferred tax liability is 2,700. Current year deferred tax liability is 600. Okay, what is the movement? They are both negative. So deferred tax is a liability. This also is also another liability. So the movement is minus 21,000. So this is it. This is what happens. Okay, let me explain to you. Okay, this is what happens. You can see that here you are not adding. Both of them are deferred taxes. Last year, in our books, we said we are owing government 2,700, right? This year, when we now calculated it, we say that is now 600. So per period, both of them are balances. We don't need to pick what we have. So we are going to look at the movement now. The movement is that before the amount was bigger, the liability was very big. It's like when you have in your books, you have like a loan. You say a loan, the loan of last year in your 2023 account, you have a loan amount of 2 million, but in your 2023 account, we now have a loan amount of 700. It means that you must have settled part of that loan. Does it make sense to us? Because in 2020, let me quickly show us so that I want us to understand this picture. I want us to understand this picture. Okay, let's say we have. Let me come down over here. I come down over here, and we have year. Let's use the current year. We have year 2025, right? We also have year 2026. Now, under here now, we now have loan amount. Let's say long-term loan, loan notes. Okay, so here now, you discover that last year, oh, what am I even doing, sir? Okay, anyhow. So this is last year, Abby. I think last year should be in this place. Let me put this one as 2014. So this is last year, and let's say we are in 2026. So we need to pay whatever we want to do should be based on 2025 because our account cannot be ready for 2026 now. So we now come here. Last year we said we have a loan amount in our books. We have a loan amount of 2,700. This year we are not showing that we are having 600. Please let me ask us, what does this indicate? Does it not indicate that we have paid part of our loan? Does it not indicate that we have paid part of the loan? Because last year is showing that we are having a liability of 2,700. However, this year we are discovering that our liability is 600. What does it indicate? Somebody that can think will say, okay, if it's like this, it means that they have paid part of this liability. The liability last year was 2007, but now it has reduced to 600. That means that they must have paid something. So that is what we are showing, the movement. This is the movement. The movement is minus 2,100. That's the movement. Are we together? Are we together? Does it make sense at all? Or it's like magic? We are not. I should repeat. Okay. All right, no problem. I will do that. Yeah. I'll do that. So somebody's hand is up. Do you have a question? Who is raising his hand? Do you have any question? Okay.
Yes,
so
sir.
I believe. Okay.
Like the carry amount, the figure you think like 48,000 that give us that 88,000, so that it can make our taxable temporary difference to 2,000. So how do we get that one? Is part of the question, or you just assume the figure, sir?
Okay, are you talking about this 40,000, this 32,000, all the stuff?
Yeah, go up small, sir.
And you go up small. Yeah. Is this not what you're talking about? Is this not this one?
Yes, but you haven't get to the place. Yeah, okay. Yes, sir.
8,000.
Yes, stars base 32,000. Yes.
Yeah. So.
Or do you just assume the figure?
Yes, all these things are. For instance, there was a question we looked at where they gave us all these figures, right? So I just assumed it. That was last year, and that is why last year we got 27. So this year we just assume another figure. Like, okay, in this year our asset will be in another position, our tax will be in another position. So we can always calculate. We can always calculate our difference at every year, because depreciation is always going to be charged every year. Our carrying amount will be every year, because every year you must have a new carrying amount. Every year you must have a new tax base. Okay, so all these figures were given to us. We only needed to check the temporary differences on it. Okay, to get your tax base, you take the cost of the asset minus capital allowance. So we don't need to start going into details how we got our tax base. We don't need to, because it's going to be the cost of the asset minus the capital allowance. Why the carrying amount is going to be the cost of the asset minus accumulated depreciation minus accumulated impairment losses. So you can see that this topic is actually interesting. You can see here now, because it's a liability, right? It's a liability. So I use a loan that is also a liability as an example. Last year, you are having a liability of 2,700. We are in another year altogether. This year, you are showing a liability of 600. What? Somebody that is very knowledgeable, we know that last year, if you're having 2,700, this year, it means that the liability has reduced. Liability now is 600. So what is the movement? The movement from 27 to 600 is this what? Is this amount? Is this amount? You have paid, it's like you have paid 2,100. Okay, you are owing 27. Here you are now showing that your liability is now 600. It means that you have paid 2,1. So that is the movement. The movement is minus 2,1. That is the movement. So it means that from this 27, you minus 2,100 to get 600. You paid out of this liability, out of this 2,700 liability, you have paid 2,100 out of it. That is why you are having 600 remaining this year. Does it make sense? It's technical, but stay with me. It's technical. So this is one method to know the movement. We can also go and use the T format account to get the movement. Okay, we can also go and use the T format account to get the movement. So what are we going to do? At any point in time, determine what we are having. What are we having at the opening of the period? We are having a liability. A liability is always on the credit side. Am I right? So follow me. Stay with me. Go to your T account. A liability is always on the credit side. So we now come over here. We come over here, right? We now say, hold on. Just give me 2 minutes. Let me connect my appliances. There is light. I can see sign of electricity. Let me connect my appliances. Just give me 2 minutes, please. 2 minutes. Okay. Just hold on. Hold on. Hold on. Yeah. So yeah, okay. So that. So now look at it now. Anytime you have this at the beginning of the year, we had a deferred tax liability is on the credit side. So when it's for last year, if it's for last year, treat it exactly the way it is. Since it's a liability, so this is it. Since it's a liability, it's on the credit side. Come and put it on your T format. Put it exactly on the credit side. No issue. Okay. Now, however, for this year, if you are also having a liability, for last year, it is a liability. Put it on the credit side as a liability. No issue. You don't have any issue. However, if you are talking about that of this year, if it's that of this year, if you're having a liability, don't post it to where liability is. Rather, we do the opposite in the actual year. In the actual year, if you have a liability is supposed to be on the credit side, go and post it to the opposite side. So if you are in the actual, if you are in, we can say that last year we had a carrying balance of 2,700. I mean, that is for last year. It's a liability. Just come to your T account, post it on the liability side, the credit side, no issue. There's no thinking about that one. However, if you also have a liability for this year, liability is always supposed to be on the credit side, but because it's the liability for this year, don't put it on the credit side. Do the opposite. It also means that in this year, if we have an asset is supposed to be on the debit side. If we have asset for the current year, we are going to post it on the opposite side. Assets normally should have a debit balance, but if it's for the current year, right? When we are looking at deferred tax liability, assets should have a current balance. Liability should have what? A credit balance. So if it's for last year, treat it exactly the way the rule is. The way the rule is. So that of last year is on the credit side. We simply come to our T format, we post it on the credit side. But that of this year, that is also a liability. Liability for the actual year, we treated oppositely. So if that come to the T format, because it's a liability, we treat it opposite. We post it on the opposite side. Okay? So that at the end of the day, when you now say, okay, we want to add everything, we say, what is the total of everything in this place? You add everything together, you're having 2,700. So the IAS part, the IAS side should be the in accounts. So let me make this thing come up as Excel. So what I'm doing is that I'm using a Word document, and because I needed to show Excel, I'm also showing Excel inside the Word document. So let's now activate this Excel to come up. So I'll just tap on it. I think, is it twice or so? Yeah, I'll double tap on it twice, and it's going to come up. Yeah, so this is it. So now look at it now. I said because the balance from last year is a liability, and liability is always a credit entry. Come and post it on the credit side, no issue for last year. However, it is also a liability, but it relates to this year. Normally, liability should be posted to the credit side, but because it relates to this year, we will not treat it all on the opposite side. What do we now do? Instead of us to come and put it on the credit side, no, we put it on the opposite direction. We now say, deferred tax liability, carry it down here first on the opposite side. When you have carried down on the opposite side, then what do you now do? You now say, okay, what is the difference? This is 27. The here also is 27. The highest side is what we normally have as the balance at the end. Then you now say, okay, what is the difference? Inside this debit side is only 600 we have. What is the difference between this side and this side? The difference obviously is 2,100. So this figure now, this 2,100 is what you're going to post. Is what you're going to post in your this is what you're going to post in your account. That's what you're going to post in your account. Actually, the difference is what you're going to post. So let's understand it. Whatever you are bringing forward from last year, treat it exactly the way it should be treated. So it means that if it's an asset, is a deferred tax asset you're bringing forward, asset are always debited. You come and put it on the debit side. If it's an asset, provided that it's from last year, treat it exactly the way it should be treated. Now, you now check, what do we have this year? Check it. Do we have a deferred tax asset for this year? If it's for this year, asset should always be debited. But because for the year, I say treat it on the opposite direction. If it's an asset you have for this year, you treat it on the opposite direction. You don't put it on the debit side, put it on the credit side. But if it's an asset you are bringing for last year, treat it exactly the rule that we are having. So let me ask us a question. Do we understand what I'm saying? Is there anybody that is lost? Is there anybody that doesn't understand what I'm saying? Please unmute your mic and ask your question. Is there anybody that does not understand what I'm saying? Hello? Okay, so if I believe you understand, let me ask you, do you understand? Do we understand? We are not saying anything. Do I assume that you understand, or I should just assume that you don't understand it? Feel free to speak your mind. Feel free.
So I
Speak your
need
mind.
to go to it again. I stepped out. I didn't really get the everything.
Oh, you stepped out. That is lovely. You should have told me now, so that I would have waited for you. Anyway, so when you're having a class, I know a lot of things can come up, but at the same time, just note that if you don't want to miss out any point, you try and make sure either you are having it on your phone or your laptop, make sure you stay to the end. Okay, so that is fine. So now let me just reiterate it. We already understand how to calculate our deferred tax liability. We also understand how to calculate our deferred tax asset. If you are going to get an asset, this amount, this guy here must be negative. If it's going to be an asset, anything negative will give right to an asset, but anything positive will give right to a liability. Okay, so a liability, following the rule of account, liabilities are always having credit balances. Where is that rule? I will say liabilities are always having credit balances. Assets are always having debit balances. So, and also told us that if it's for, so this rule applies only for transactions that you bring from last year. This rule will apply. Now, if it's transaction that relates to this year, it will change. It will be the reversal. Okay, it will be the reversal. So now, if it's for last year, you are having this, you are treating this way. But if it's for this year, you are treating it the opposite way. So let me now come here. So this is we are looking at I don't know how to say it now. Okay, so let's continue. So let's continue. To make it easier, okay? To make it easier, let me say something. To make it easier, I don't want us to start thinking too much. I don't want us to start thinking too much, okay? To make it easier, it's a liability. Liability for last year is a liability. We posted it normally, okay? But for this year, it's also a liability. So instead of you to put it down on the liability side, therefore carry it down to the opposite direction. So it's a liability, fine. It's for the year. We are supposed to put it on the credit side, but no, carry it down to the opposite direction. So that's why we're having it here on the opposite direction. So at the end of the day, you discover that here, let me delete what is here, because let me double tap to activate the Excel. Okay, so I'm coming. Let me do something. I want us to see it well. Let me click here. Okay, so this is it. So at first, when you carry it to the other side, this is what it looks like. This is what your account looks like. Okay, it's looking like this. It's showing us that we only have 2,700 here in the whole of this credit side. We also have only 600 in the whole of this debit side. However, in accounting, you need to balance your account. So which side is the IAS account? Which side is the IAS? Obviously, 27 is higher than, that means that the transactions inside the credit side is higher than the transactions inside the debit side. So whichever is higher is what we normally pick as the balance. So come and put the balance here. Okay, we also come and put the balance here. So now we now say, okay, to make what is inside the credit side is the same, no difference. The balance is correct. But what is inside the debit side, the balance is saying it should be 2007, but here we're only having 600. That means that we need to say this to get the difference. We say this 2007 minus the difference, 2,700, sorry, minus the difference, minus 600. We are going to get the difference. So how do we do that? We now say equal to, we now say this value that is here, okay? We now say minus, we now say, don't just, because most times you're not going to have only one figure. Don't just say minus, don't just go and click on this side. Don't just go and click on this thing like this. Don't do that lazy man work, okay? Don't do that lazy man work. So what do? You now say, because at times, this is your debit side, you could have many transactions. It could be 50 transactions that are listed down like that. So you now say minus sum, open your brackets, sum, you now come here, you now select everything that is inside the debit box. You now close your bracket, and you now click on enter, and it gives you what the answer should be. Are we together? Are we together? Okay, I believe we are together. Even if you don't say it, I believe we are together. Okay, you don't leave me. Don't leave me. We are together. So now they now say that is an increase in provision for deferred taxes. So therefore, if current tax is 800, we are just making an assumption. If current tax is 800 for the year, okay. Hold on. Yeah, so we are saying, therefore, if current tax is 800, the tax expense to recognize in the statement of profit and loss is going to be this minus this. If current tax is, I think this current tax is it not 30,600? Sorry, this should be 30,600 now. What am I saying? This is 30,600. So if current tax is 30,000, comma 30,600, yes, then the tax expense recognized in the statement of profit and loss is going to be the movement. It's going to be the deferred tax, sorry, the current tax plus, they say deferred tax plus movement in deferred taxes. And what do we have a deferred tax this period? We have a deferred tax. What we have here, what we have here is an asset. Assets. Now, assets are, so this is what we have. So we are having a negative amount. So deferred tax minus this. So that's how we are able to get this. So now, normally, our liability, current tax is a liability. Deferred tax also is a liability, right? So now, both of them are liabilities. However, this one is now going to be we are going to minus this one. It's going to be a negative 2,1 from this amount, so that we're going to have this 28,500. So this is a liability we are going to post now. So that is how we're going to do it. So that is that. Are we together? Are we together? So let's try one more. Let's try one more. Okay. So let's try one more. So let's assume for last year we have a deferred tax liability of 1,000, right? So I told us if it's for last year, post it exactly the way it should be. However, this year also we also have a deferred tax liability of 700, but because of this year, therefore it's a liability. Liability is supposed to be on the credit side, but therefore carry it over to the opposite side first. So we now carry it over to the opposite side. Okay. So now when you now say, okay, here we have 1,000, you add everything is 1,000. Then here you now check what is the difference between this side and this side. The difference is 300. That means that you are going to say you have 300. So the difference is going to be minus 300. Okay, so it means that initially you have a liability of 1,000. You have paid out of it. You have paid 300 out of it. We are now left with 700. So at this 1,000, we less 300 from it to arrive at 700. So that's why we're having negative 3. So we now come over here. We now say the movement is a decrease in provision, okay, for deferred tax by negative 300. We're not saying that, therefore, if current tax is 800, the tax expense to recognize the statement of profit and loss is the movement, which is going to be the current tax of the period plus the movement in deferred tax. So what is the movement in deferred tax? The movement in deferred tax now is minus 300. So we now come here, and now say 800 minus 300, we're going to have 500. Right. So I think we are done with the class, but I wanted to show us for assets. But let's leave it till next time we meet. Remind me that next time we are going to continue from here. It's not difficult if you practice makes perfect, right? If you practice well, you discover that it's not actually difficult. It's not difficult. So for asset, deferred tax asset is always going to be on the debit side. So you come here for the year post on the debit side. Now let's now say we also now have another deferred tax asset for the year. Now because it's a debit, you're supposed to put it on the debit side, but carry down to the other side, opposite. So we now carry it down to the opposite. We're out. So what if this is our deferred tax is actually a deferred tax liability? So we now say, okay, because liability is supposed to be on the credit side, we now carry down to the opposite. So just do it that way. It's the same thing, but no problem. Once you see this recorded class, and also we meet again, we still try and touch it on it. I'm sure you'll be able to solidify your understanding. So with that, I think we are done with the class for today. If you have any question, kindly ask now. Any question? Did we gain from the class? Was the class interactive? Was it informative? Did you gain from the class?
Yes, but I have a request rather. The first class, the IAS 36, the impairment of assets, now the recording for it, I've not seen it. I think it's the other one that I saw in the group 12. I don't know if you can send the recording for that one so that we can learn from that first point to this last point of the class.
Okay, no problem. I'll do that. Mr. Raymond, your voice is sounding like the voice of a rich man. I'm sure you're a rich man. Your voice is.
No, please, I'm a humble civil servant. Thank you.
It's all right. Thank you, sir. So others, do we have any question? Any other person? Mr. Ridwan, your mic is unmuted, but I can't hear you. Mr. Kufre Johnson, any question? Ademaki, do you have any question? Madam Rebecca, do you have any question? Or we should just call it a day? Okay, so with the absence of any question, Madam Rebecca, any question?
No, sir, no question so far.
All right. So on that note, we stop the recording and we stop the class. Now let me also ask us